Hello everyone, I'm Rodney Hathaway, Chief Investment Officer here at Waukesha State Bank Wealth Management, and welcome to our August edition of Market Chats. One of the most significant economic shifts over the past 18 months has been the sharp slowdown in immigration, and it's beginning to influence several key areas of the U.S. economy. A common concern among investors today is slowing job growth. However, the data outlined by First Trust Chief Economist Brian Westbury suggests we need to view today's labor market differently than in prior years. During the previous administration, strong payroll growth was supported by a rapidly expanding labor force that included millions of new immigrants. Today, job creation has slowed substantially, yet unemployment has remained relatively stable at near 4%. In other words, slower hiring does not necessarily mean a weaker economy when labor force growth itself has slowed. We're also seeing an interesting shift in wages. According to the data, earnings growth has been the strongest among lower income workers and workers without college degrees, while wage growth for higher income workers has been much more modest. The economic explanation is straightforward. A tighter supply of lower skilled labor is increasing workers' bargaining power. Housing is another area being affected. Home price appreciation has slowed dramatically, while rent growth has been flat or slightly negative nationally. With fewer new arrivals competing for housing, rental supply has become more available, helping cool both rents and home price increases. So, what are the investment implications? First, investors should be cautious about interpreting slower payroll growth as an automatic recession signal. Demographics and labor force trends matter. Second, moderating housing inflation could help keep broader inflation pressures contained, supporting the possibility of a more stable interest rate environment. Third, stronger wage growth for lower income households may support consumer spending, which remains the largest driver of U.S. economic activity. And finally, a slower but more balanced economy is not necessarily a negative backdrop for investors. If inflation remains contained while employment and consumer spending stay resilient, it could continue to support earnings growth and a constructive environment for diversified portfolios. This is another reminder that looking beyond headline numbers and understanding the forces driving economic data can create better long-term investment decisions. Thank you for watching, and please reach out if you'd like to discuss how these evolving economic trends may impact your portfolio and financial plan.